Hello, good morning. Today we are talking about discuss about the stock portfolio. So the long-term investor should consider the wealth portfolio. Wealth portfolio means is mixed up the all kinds of the sectors, industries, and different types of the market capitalization companies. Different kinds of the different kinds of the market capitalization. This is called as a stock portfolio. The modern portfolio tell us to the stock portfolio not the stock portfolio the stock asset value should not should not be exceeded above the 60%. Because of we should maintain the 40% of the other kinds of the risk-free investment. Risk-free investment means such as gold, real estate, and the credit bond investment. This is this is given. This is despite being a very low return to the investor, but it will reduce the risk of the total stock value and the asset value. The stock portfolio is a very riskier asset classes when compared with the other asset classes, but just you look back to the historical average return of the stock portfolio around 14%, which is very higher than the other asset classes. So how do we construct the portfolio? Portfolio means diversification is a primary thing. Diversification means you are putting your money into the different kinds of the industry. Why do we need putting our money into the different kinds of the industry? Because of we don't predict the market direction and which sector will outperform in the future. So in order to reduce our risk and in order to balance our asset value and market risk, so we must spread across the different investment in the different kinds of the industry. So first keep different kinds of the industry. Different kinds of industry means IT, pharma, financial sector, automobile sector, metal stocks. These are called the different kinds of the industry. Each industries will outperformance in the different stages of the market cycles. So as a stock portfolio constructor, we must put your money into the different stages of the business cycles. First, we need to understand what is a business cycle. Business cycles mean the recession and the peak market. Recession means economic contraction. Peak market is the economic expansion. So each sector will different performance in the different stages of the business cycles. For example, in the economic expansion, the cyclical stocks will do well performance in the market. At the same time, non-cyclical economic contraction, the non-cyclical stocks such as the pharma, IT, FMCG goods are doing well performance in the market. So we should align with our portfolio as a business cycle stages. So each when you enter into the different phase of the business cycle, we should allocate our funds wisely and wisely according to the business cycle stages. For example, the expansion stages, we may put more money into the cyclical stocks. At the same time, in the diminishing period, we should shuffle our portfolio and divert money into the dividend dividend paid stocks, and FMCG stocks. These kind of stocks will reduce your risk. Cover your risk through diversification. Diversification is very must for the portfolio construction, because of diversification will helps to reduce your risk. At the same time, manage your balancing your asset value. In order to maintain our asset value in the certain range, we should diversification is inevitable. Diversification is key for portfolio construction. Whatever diversifications, it may be the small cap, mid cap, and mixed up with your portfolio should be placed with the small caps, mid caps, and the large cap stocks. At the same time, the different kinds of the industry. So you must avoid the business cycle and the unexpected market crash and the reversal of the market trend and the market corrections. Always will be your portfolio will be in the certain range, and will be a good valuation. And the primary thing is reduce manage your asset, maintain your asset value, and in order to reduce your risk. This is the main goal of the portfolio. Reduce the risk. Reduce the risk means that diversification is a key tool for reduce your risk. At the same time, improve your return wisely. Improve return wisely means which kind of stocks you will pick. You are going to pick up and putting into your portfolio. Portfolio means your portfolio may be. Your portfolio may be constituted of the higher large cap stocks or FMCG stocks. Means your portfolio less risky. At the same time, your portfolio growth also may will be moderate. Growth will be moderate. So you must pick up the stocks according to the business cycle. Business cycle is very important. At the same time, business cycle and the interest rate cycle are also driving factors of your portfolio value and the portfolio return. And you can measure the portfolio risk. So that many portfolio managers are striving for reduce the risk and increase the value of the asset, increase the asset classes value. Asset classes value not only to the bond market. If you go to the bond market also riskiness, because of the underlying face value will change very often along with the interest rate changes. At the same time, the gold rate is correlated with the currency rate. And correlated with the currency rate, real estate investment is correlated with the economic expansion and the demands of the housing sector and the job market. So if job market is well, the real estate market will pick up very soon. At the same time, the currency volatility is occurring in the certain period. Your gold investment will give the best return to the investor. So you could maintain your portfolio. So the risky-free asset classes, support the higher cash flow. At the same time, the riskiness cash flow, risky investment of the is risky investment of the stock market will give the higher return to the investor in the long term basis, not a short term basis. Sometimes it may happen into the short term in the short range, but portfolio investor may consider should consider the long term basis. Consider the long term basis, not go to not focus on the short term basis. This is the portfolio principle of the portfolio, foundation of the portfolio. You must. I think that you would be understood very well about the portfolio. What is a portfolio? It is a basic principle. Portfolio is a very broader perspective. Broader subject. Even consider the portfolio needed. Consider the portfolio needed a large statistics and a financial model and financial model, business analytics, and market volatility. These factors will be considered when you construct the portfolio.